Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. This is a preview for the upcoming ECB interest rate decision taking place on Thursday. We're expecting to see a rate cut, but the question mark here is exactly where does this easing process end and what would be the market reaction when it does come to an end, or at least we see the signal of an end to that easing. So let's look at the market expectations for the meeting. This is according to the Icon platform. You can see here that expectations for this meeting are 95% chance of a rate cut. So by and large, a rate cut is factored in. If we do see that cut, don't expect to see fireworks unless we saw a cut over that 25 basis points, and markets really aren't considering that right now. So a move to 175 pretty much off the table. A rate pause would be the outlier move. 5% chance attributed to that. It seems unlikely. That's why it's a 5% chance according to markets. But of course, if we did see that pause, then you're likely to see maybe equity markets suffering a little bit as a result, the euro gaining a bid. But the question mark here isn't really whether we're going to see a rate cut at this meeting. Instead, it's going to be the case of looking further out and seeing exactly where this process ends. And that's because the ECB is ahead of the curve when it comes to easing compared to many of the other central banks. And so we don't necessarily know where they want to draw a line under this easing. So you can see in terms of market expectations that there's an expectation that we see another cut roughly in September, more confidently in October or December. But beyond that, if you look at the December figures and you can sort of compare it down towards the next year, don't really see much changing. Don't see much movement in that. And so it points towards markets essentially pricing in 2 rate cuts, including this one. And then from there onwards, you've got essentially near enough a sort of coin toss, maybe worse than that. So roughly 40% chance that we're going to see an additional rate cut beyond that. So 175 is the safe bet for where rates will be for the ECB by the end of the year. And beyond that, markets don't really have a view. There's a perception that the rates are going to stay at 175. Is that the case? And so where we often see pricing of markets, relative markets in particular, let's say the FX markets, often playing around relative yields, relative interest rates. Of course, you could see the ECB, which is already sort of on the front end, really, when it comes to those banks that have been cutting interest rates. If they were to stop first, then we see other central banks continuing to ease or planning additional easing, then that could see significant movements around the strengthening of the euro because of that, in particular if the eurozone starts to strengthen in terms of the economy as a result of that easing. So much of the sort of focus for markets going forward will be where is that sort of terminal rate or that neutral rate, or essentially the rate that they stop cutting interest rates. We don't necessarily know that it'll be 175, and that's certainly something we're going to be looking out for at this meeting. What will Christine Lagarde say, with a view to informing the markets on where the committee expects interest rates to go beyond the next couple of cuts, because we're expecting to see one this week. We're expecting another one in September or October. But beyond that, where do we stand? So I actually wanted to show you first and foremost. So this is actually, I've got US inflation. This is the one that I haven't changed the title. This is the comparison between interest rates at some of the major European and sort of America's central banks. So we've got Bank of Canada, the US, so Federal Reserve, the Bank of England, and then the ECB. And so the reason for me to show you this is to sort of take a wider view and try and look from a historical perspective where are rates generally flatlining. So you can see post 2007, 2008 crisis, we saw interest rates slashed and they remained very low for an extended period of time. Now, we're not in that phase now. So there's a question mark over the validity of cutting rates back down to where they were during that extended period of time. So you can see here when it comes to the ECB, we came into negative territory on the deposit rate. You can see the Fed funds rate, marginally above zero. In terms of the Bank of England, a similar kind of thing between 0 and 1%. The Bank of Canada, a little bit higher than that, more like 1%. So the question mark is, where does this end? In actual fact, once those rates have been slashed, there was some consternation within markets of people saying, look, you can't keep rates here forever, because when the next crisis comes, you haven't got any sort of leverage to be able to intervene once again. And so what you did see is rates rising up until the pandemic, and then were slashed once again. We've now seen them rising once again. And so they're falling. So where does the neutral rate come in? Well, you can probably look at where we were pre-pandemic and say, that's where some of the central banks probably want to be around. But for the ECB, because of the struggles that we saw within the economy, they didn't really have the opportunity to, or the strength to be able to be hiking interest rates. So the ECB stands in sort of stark contrast to some of these others, because they were hiking interest rates into the pandemic. That wasn't the case for the ECB. So where do we go in terms of rates for the ECB? Like I said, market's pricing 175. Maybe it's a case of getting closer towards 1.5, but is there a justification of getting below 1% back to those kind of levels? I don't necessarily think so, quite frankly. And certainly it comes down to what the fiscal policy is. And the fiscal policy landscape within the eurozone is changing, because there's going to be more spending on defense, more spending on infrastructure. 3.5% of GDP is what the UK apparently is going to have to pledge according to requirements under NATO. So Donald Trump's certainly pushing. And so it means increased spending. That spending is likely to make up for some of the shortfall of interest rates if interest rates are higher than they were previously. But so that's a big focus. Now, where are we in terms of the economy? Does the economy in the eurozone need additional interest rate cuts? Well, in actual fact, we've been seeing a significant recovery in terms of the manufacturing sector, and it's the services sector that has been driving down the composite number. Both of them now below, all three of them below that 50 threshold. So the economy isn't in great shape, but certainly there's some optimism around manufacturing, in part because of the fact that we're seeing optimism returning into Germany, and we're seeing that expectation that we're going to see increased spending domestically. Of course, we still have those concerns around the tariffs, but certainly there's some improvement on the manufacturing side at least. In terms of inflation, it's an interesting one, because we've just recently seen the Eurozone inflation metrics, and it came out at 0%, both headline and core on the monthly figures. That drove both of the year-on-year figures lower. You can see here 1.9% on the headline inflation figure, so that's below the 2% target. If we're to look at the outlook for inflation going forward, let's look at the numbers that are dropping out, and you can see that the only real significant numbers that we will await to drop out for big disinflation have just happened, right? February, March, April, 0.4, 0.6, 0.6. So I think there's a good chance that we, by and large, see inflation sort of stick around where we are at the moment, maybe move a little bit higher, but it's at target. So it's not necessarily a problem that allows the ECB to think that they're in a position to cut if they need to. Core down to 2.3%, so above 2%, but still in a good position. You can see that the last three figures prior to the 0% monthly figure were 1%, 1%, 0.6%. Now, we did see that minus 1% in January, so you'll see some of that netting out. But certainly it's a similar kind of picture where if you look at the previous numbers, you could say, January of last year, 0.4. So once that January figure gets replaced, if we see something like this, we saw 0% this time around. If we see another low figure, 0.2, let's say, then we start moving even closer to target. So I think inflation is pretty much under control, unless we see more 1% figures coming into play. But by and large, the sort of weakening demand that might play out from the US because of tariffs isn't necessarily inflationary in nature. And of course, if we see a sort of tit for tat trade war where they suddenly start hiking tariffs on US goods, then that's different. But instead, you're seeing the potential for disinflation in terms of how much local businesses are going to be able to charge, and then imported inflation from the likes of China, because China, if they're not selling to the US, they're going to have to find some buyers for their products elsewhere in the world. And that means potentially dumping their products on other countries that they're friendly with. Europe is one potential developed target audience. And so you could see sort of cheap Chinese goods coming into play. The Caixin manufacturing PMI just this week did show that we saw a decline in terms of the export prices. So it does highlight the fact that we're seeing Chinese producers dropping their products, the price of their products. So all in all, we've got the potential for sort of controlled inflation and disinflation playing out. We've got weakness in terms of the PMI numbers, but a recovery in terms of manufacturing in particular. And then we've got the outlook for interest rates to fall further, but we don't necessarily know exactly where they're going to fall to. So what's going to happen this time around and what's going to happen further out? Let's look at the FX markets. Let's look at indices. So first and foremost, we can look at the chart for euro sterling. So I wanted to look at euro sterling. Quite frankly, I could look at euro dollar, and the dollar keeps weakening. So it's makes it quite obvious what that trend is, but I just wanted to look at something different. So what we're looking at here is euro sterling from a sort of long-term perspective. Here we go, is in a sort of bearish trend. Of course, we had that sort of rally. We had the Brexit rally coming into play, where we had the weakness of the pound. But by and large, you can see here in terms of the trend, the bottom end has been sort of quite clear cut in terms of that downward trajectory, but not necessarily going much beyond this sort of trend line support kind of area. And then more recently, we've seen this pop coming into play at the beginning of this year, where we're seeing some increased confidence around the idea that the eurozone is going to do well because of increased spending and the like. So all of a sudden, it doesn't look like this sort of problem child like it had done in the past. So if you look in terms of the daily time frame, we have got this sort of uptrend that's been playing out since the lows here in March. But we've come into a very deep retracement, if it is a retracement. And the fact that we've gone beyond all of your fib levels does, to me, point towards the potential for a continuation of this weakening phase. If we look in terms of this near-term rally that's just taken hold, you can see that from an intraday perspective, we've, again, also come beyond all the fib levels. But what we haven't done is drop up, or pop up, should I say, through your 84594 level. Came very close to it, now starting to roll over. So certainly if we were to see a break below this 0.84 level, in my mind, that looks primed to then drop back down to 835 kind of area and continue this downtrend that's been playing out over the course of the last month or so. So yeah, I mean, look, for the time being, a rate cut, that's what everyone's pricing in. Where are we going to see the next rate cut? Are they going to come out with something that's dovish? Well, the inflation data does provide the basis for them to be able to do that. It's just a question mark of exactly where they see rates resting over the long term. And for all of the fact that they'll want to help the economy, I don't think they're necessarily going to want to be in a position where they have essentially taken everything, fired all their shots, so to speak, from the tank, and therefore they don't have anything if we do come into some problems down the line. So we could see the euro strengthening and this pair potentially turning upwards once again if we see them providing an outlook that signals that they're pretty much done here, and in which case a breakthrough 84594, that swing high, could provide the basis of another leg higher here for euro sterling. So should be an interesting one on the FX front. In terms of the indices, well, the DAX has been a big outperformer. If you look at the DE40 divided by SPX, put it on a different scale, you can see here this strength that we've been seeing comes alongside outperformance against US assets. That is not a historical norm, as we can see here. If my computer decides to load it, there we go. The historical trend is underperformance for European markets compared to the US. However, you can see that we saw that strengthening back in sort of 22 coming into 23, and now that strengthening once again come up through that high. So arguably, we've been seeing some questions being asked of US markets compared to the DAX that haven't really been asked too heavily in the past. Of course, we did see this phase in 2016. So, have we reached a bottom? Are people going to reallocate away from the US? That remains to be seen. But certainly, given the fact that we've got the expectation of additional spending coming into play in the region, if we see risk on appetite within markets as a whole, it's likely to be the case that we see continued strength in terms of the DAX. So look, if we were to put a trend line, it's quite difficult, to be honest, because, you could say that's a trend line break, but then ultimately it just goes on to a little bit of a shallower slant, and therefore you move on to this, and then it's broken through here. So you can see from that it is sort of gradually starting to roll over in a way. It's more sort of flatlining now, and it's losing a bit of momentum, I would say. So, that is definitely worth noting. And if we start breaking through this sort of zone down here of 23267, 23336, then that looks like a potential top. But at the top end, we are still making some tentative new highs. We've sort of pulled back a bit more now, so potentially into a deeper retracement. So some questions are being asked. If we see them coming out with a very dovish stance here, then the bulls will be back into play in my mind and breaking up through that prior high. But if we see them essentially saying, maybe the next rate cut is our last in the process, then there could be some that are very reliant on that easing to think, that's me out. I think, I'll get into areas where the central banks are still easing. So that's the key thing here. We are sort of seeing this ABC style retracement at the moment. If we pop up through your 24174, then it looks like we're going to break through that prior high. So there is a good chance that this is a retracement. The trend still is bullish, but I am aware of the fact that what was a relatively steep recovery has now started to peter out a little bit, and it's losing some of that momentum. So if we do break through that swing low that we have at 23267, then that's going to point towards this market potentially having topped out. For the time being, at least, I don't think we're going to get back down to the prior lows. It'd be a case of a retracement of that wider move before the bulls come back into play. But we're not in that place right now. Instead, we're in a place where that bullish trend still does play out. And if we see the ECB coming out with supportive comments, then it's likely that the bulls will remain in charge for the time being anyway. I hope that's been useful. My name's Josh Mahony, Chief Market Analyst at Scope Markets. Make sure to like, subscribe, and follow for more. Thanks a lot.